Good evening, everyone. My name is Neil Bawa, and I'm delighted to have you on this webinar. This is my favorite webinar. I teach it 12 times a year. It's called Multifamily Fundamentals. My goal is to give you some aha moments about the amazing world of apartment complexes and tell you a little bit about the foundational concepts and some of the benefits of multifamily investing. We'll also talk about some of the downsides of multifamily investing compared to single family. So let's get started with a little bit about our agenda. We're going to start with some questions. I'm going to ask some big questions that if you're looking to have investors invest in your projects, you might want to ask them as well. The big why questions and the one how question. Then I'm going to introduce you to one of the largest markets in America. Imagine $1 billion. Now imagine $2,000 billion. That is the size of the US multifamily market. We're going to talk about the latest market trends that have been driving absolutely insane multifamily growth. And for those of you in the Bay Area, you might think that the party is coming to an end. I think that in 60 minutes, you're going to think differently about multifamily. We're going to explain how groups of investors get together to buy very large apartment complexes, which essentially are very large businesses, and then assign a property manager and an asset manager to manage that large business. We're going to talk about the top reasons that people have been investing in multifamily for over 1,000 years. And then we're going to briefly and very quickly go through the entire life cycle of a typical multifamily project. So it takes 2 to 7 years, and I'm going to go through that life cycle in about 4 minutes. So it's going to be quite a ride. And then we'll follow up with we'll do a review and we'll take questions. I'm going to ask you those 3 questions. My first question is why? Why must you or your investors expand their portfolio beyond stocks and bonds? That's a very key question that everyone should be asking now. People might say, well, Neil, you're just asking that question because the stock market has crashed. No. This question will still be there if the stock market goes up 2,000 points. The second question is also a why question. Why must you seek higher yields? Why must you seek higher yields? Now, higher yield simply means a higher return, which comes with higher risk. That why is a very critical why, and not enough people ask it. The third question is a how question. How can you or your investors invest in real estate passively without managing, without rehabbing, without flipping? How can they do that? So that how question. And the answer to all of these 3 questions are really wrapped up into 3 answers. I'm going to give you 3 of them. And the first one is that America's Social Security and retirement planning system was designed for an altogether different reality. 3 reasons for that. Number 1 is life expectancy. So if you look at life expectancy, your great-grandfather worked until the day he died at the ripe old age of 49 in the year 1900. And by the year 1960, people were living up to 69. So the retirement system, this retirement system, which was designed in the 40s, 50s, and 60s, was designed for people to live up to the age of 69. So your retirement had to last just a few years. It worked. But today, that age is 79 years, 83 for women, and rising fast. We are just at the cusp of biotechnology breakthroughs that could easily take us over 100 years of lifestyle. And no system designed in America takes that into account. The second reason is just as important. Healthcare costs are rising far faster than inflation. Now, wages have risen on an inflation-adjusted basis over 16% over that time frame. Gross domestic product, or GDP, of the United States, 168%. Healthcare costs, look at that, 818% up. You know what's really sad about healthcare costs? The vast majority of this 818% comes in the final 10 years of life, when your ability to work and your ability to make money is decreasing. This is so critical. The third one, which a lot of people argue with me about, is stock market returns adjusted for inflation. They forget about these words. Adjusted for inflation are far too low to get ahead. You really need to turn your dollar into $10 or $20 to retire. Well, is the stock market doing that? Let's take a look. What do you think is the actual annual growth over the last 17 years, adjusted for inflation? I put that in red for all of you out there. If you invested a buck on Jan 1st, 2001, and you took it out 17 years later, and you adjust for inflation, you include dividends, then your buck has grown to a measly $1.99. That's right. In 17 years, your buck has become $1.99. So what do you really need to do to get ahead? Well, there's two things that I argue everyone needs to understand. The first one, some of you may already know, understand the magic of compounding returns. What that means is, if you make a great investment over 5 years and you double your money, the worst thing that you can possibly do at that point is basically go out and buy a Tesla with that money. What you really need to do is reinvest that money. And whenever possible, tax-sheltered reinvestment. The second piece is that, in my opinion, it is actually more risky to only have low-risk items in your portfolio. You need to add items to your portfolio that are higher yield, higher risk. Yes, they come with higher risk, but not taking a risk is the greatest risk of all. If you invest $100 and you invest it for 30 years at 3 different levels of returns, what do you end up with at the end of those 30 years? Well, at 2%, your $100 has become an absurd $182. Well, that's definitely not going to help you retire. At 10%, it's higher. That $100 has now become $2,000. But still, if you look at the amount that you need to retire, that may not be very impressive. Here's what happens at 18%. When you invest at 18% for 30 years, your $100 becomes $21,000. If you want to have $15,000 per month in passive income 20 years from now, how much do you need to save and invest each month today? And this is compounded investment. Well, and keep in mind, $15,000 might sound like a lot to some of you, but 20 years from now, $15,000 is going to be more like $7,000 today. So it's not a large amount of money. So if you want to have that $15,000 at 2% annualized returns, you need to save an absurd $30,530 post-tax per month. Let's talk a little bit about my day job and what I do when I'm not teaching these kinds of webinars. Well, I run an investment company and an education company. My investment company is called Grow Capitus. We source, negotiate, and buy commercial properties across the US. We bought 3 properties in the last quarter, 500 plus units. The current portfolio is 1,800 units. We're going to be at 3,000 units this year. We now have 300 investors that are invested in our portfolio. The portfolio includes both multifamily student housing in 7 different states, but all of that is great, but what I really love doing is teaching and opening people's eyes. What I'm doing right now is the most fun part of my day when I teach webinars in the evening, and I teach about 4,000 to 5,000 students a year that attend both my webinars and seminars. I fly all across the US. I'm teaching 5 times in 5 different cities this quarter, and then many hundreds attend my Magic of Multifamily bootcamps. I also love podcasting. So I chat with a podcaster every week. There's over 50 podcasts that I've been featured on. So check those out if you would love to learn more about multifamily. They're on our website, which is this one here, multifamilyu.com. What does the term multifamily mean? Well, multi implies 2 or more, but actually what it means is 5 or more. And it reaches true economies of scale, what we call institutional class multifamily, at 150 units. At that point, you can afford to have enough people working full-time in a property to have a high level of control over it and run it like a business. Multifamily properties are valued not based on your credit, but based on their income, their net operating income. They're not really based on comparables, though we look at those. They're based on income. And here, right here, is the most important 1 minute of this presentation. This is what you're here for, that nugget, that golden nugget. So grab a pen and understand what I'm about to say.